Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Wednesday, the 19th of February, Swizz here, along with Elizabeth Young Thomas, she of SoFi, Dan Nathan, he of Risk Reversal Media. Dan, if it's Wednesday, it's
Liz Thomas. Most definitely.
Yes,
okay.
I mean, obviously, I
know.
said
You know what I'm trying to. You know,
down.
Liz, what I'm trying to do. Keep them
Let's
away
try again.
From, keep them away
If
from
it's Wednesday, it's
Butters.
Bitch, yes, it is, and I am excited to hear what John Butters.
Except that Amanda's telling us that there is no John Butters today.
What?
So, guy, thanks a lot for looking the rundown. That way, we get
Wait
double.
a second. How is that possible? I'm
here.
sorry, Amanda. I'm
He's
so
off this
used
week.
to.
Guy, where do you think he is if he's off?
It's a
this week?
Pavlovian thing. Wednesday Butters. It means he's in Wisconsin or New Hampshire or something. I think what happens with Butters is he gets inundated. The fans are so vociferous that he needs to take time off every once in a while.
Sure. Liz, you're going to be taking a little time off in the not so distant future.
I sure am.
There's going to be a lot of CNBC and Market Call fans that are really going to miss you for about 3.5 months.
I think they'll be okay. But
what are the SDs going to do on the HTR in your absence?
SoFi gives you 4 months.
4.5. It's 18 weeks.
Whoa,
is what I.
You know who doesn't have 18 weeks is the Risk Reversal Media, Amanda. Just
Amanda, hold on a second. I will make an executive decision here, and this is on record. Amanda can take as much time as she and her family and her new baby need.
All right, fine.
Let's
get to the markets here because I cannot confirm or one way or another.
Yep, you're in dangerous
The guy does overrule me quite often.
I'm not looking to overrule. Up with what Amanda just said. Noted. So Butters is off. Okay, so let's get into it right now because the S&P 500 made a new all-time high today, 6135 and change. It's basically unchanged as we're sitting here. The VIX is unchanged at 15. A lot of unchanged things. The Dow's lower, but whatever. Nobody cares about that. So let's look at what seemingly so let's look at the S&P chart first because here you go. And this is something we've seen for a while now. What will be interesting today to see how we close, because obviously, as I just said, Dan, we made a new all-time high. So if we were to close below yesterday's low, you have a bit of an engulfing pattern. We'll see. As I'm sitting here, though, one thing that is sticking out to me, and Elizabeth can opine about this, is the TLT or, yields, which, again, have been volatile, and we find ourselves, right around this, 454 or so level. So let's start with the S&P 500 first, Dan.
Yeah, and Liz, I'd love to get your take. So maybe Amanda could pull up the RSP, the equal weight S&P 500, because, if you look at that chart that we have up there, you take the S&P off. If you said to me, this stock is trading here, they're going into earnings next week, expectations are this and that or whatever. I say, well, that looks like it's ready to break out. You know what I mean? That was the SPX. Here's the RSP. And what's interesting about this, that whole narrative that we are broadening out as far as the market's concerned. We've seen the fateful 8 kind of stall out a little bit, a handful. I think 2 of them are up on the year. And yeah, that's it. No. Meta is up 20%. Amazon's up 2% and Nvidia is up about 5%, but the other ones are down. So they're definitely stalling out. Liz, when you see the RSP, the equal weight S&P doing this, it's gone basically sideways for about a month or so. What does that make you feel about the S&P that has consolidated back towards those all-time highs?
Yeah, I mean, well, obviously there was a handoff and a passing of the baton back to mega caps, back to large cap. And that actually is happening around the globe right now. And a lot of times, and we talked about this, it felt like 2 years ago, not probably was 2 years ago, that late in an economic cycle, you do see large caps lead and you don't necessarily see small caps or mid caps picking up much of the slack. That's something that happens early in an economic cycle. So this would tell me from an economy standpoint or from a cycle standpoint that the market is not sure if we are early or late anymore. And I think a lot of that has to do with what the Fed has been saying. We do get Fed meeting minutes in about an hour, and the expectations are that we're going to see that the Fed is more comfortable with a prolonged pause here. So we'll see how the market reacts to that. Also, you mentioned yields. I'm looking at the 10-year yield. There was actually just a drop. It wasn't dramatic, but there was just a drop. I'm wondering if there was an auction.
We had a 20-year auction, and that's what I have my head in my machine looking to see the results. But there was a 20-year auction, which, given how the how the TLT is trading, suggests it probably wasn't as robust as the market had hoped. Back to you.
Yeah. Hey, Guy, really quickly. So what Liz just said about passing the baton back to mega cap tech. We've been talking a lot about just kind of the over exuberance in the infrastructure spend, right? The CapEx. We spent a lot of time when we heard Microsoft, Meta, Google, Amazon, their CapEx spending are expected for 2025. And, we had expected that you'd get a bit of a digestion phase, if you will. There was so much, again, buying of these names, and there was a lot of stuff that was kind of, just fell by the wayside within tech. Let's pull up the SOXX, the ETF that tracks the semiconductor index. And, this one is interesting because we know how much time we've spent talking about Taiwan Semi and NVIDIA and how much of their performance and their weighting has, done for the semiconductor space. But look at this one right now. And I think this is interesting. So obviously Intel had a big move. I'm just going to read off some names. You said this on our Fast Money call today earlier. You don't know why it's happening, but Texas Instruments is up 5%. Marvel is up 4%. NXPI is up 5.5%. On the year, I just want to tell you what some of these other ones are doing. So Intel's up 28%, Micron's up 23%, Global Foundries up 6%, Western Digital up 20%, STX up 20%, Qualcomm up 13.5%. So some big movers here. ARM is up 27%, NXPI up 15%. So when you think about this, you look at that ETF, it's stuck in the mud here. It's filled in that gap a little bit from that DeepSeek day. But is this a group that you think remains range bound without some very obvious leadership, especially if you see NVIDIA? Because to me, this is a big part of the tech story.
Yeah. All right. So if you want to play the game, so if Amanda, I don't know if she can do this, so I apologize, but if you go to the July high of, I think it was like 270 or so, and then draw a trend line down, the second point's going to be this recent high. So there'll be a third point coming in, almost where we're trading now. So there's your downtrend line. Boom. Okay, so draw that. And so you'll see where, there you go. So the uptrend line will be off the August low, and the second point will be off this sort of recent low as well. So this pennant formation is seemingly intact here. What does that mean? It means with each passing day, Dan, and as you know, that range is going to get smaller and smaller, and something's going to give. I will tell you, the fact that we filled in this downward gap is both encouraging and potentially disappointing, because I think it's going to be potentially a bit of a failed breakout here. So maybe we touch the third point, make a third point of that downtrend. But I think what's going to wind up happening is NVIDIA, this is just me pontificating, NVIDIA is going to report, and we're going to find ourselves at the lower end of this pennant formation, Dan.
Yeah. So Liz, we were talking on our call again just before, NVIDIA is the one that it seems like every quarter people are like, that's the Super Bowl, that's the main event. And, we haven't had really any massively disappointing guidance or results or anything that people are extrapolating, that could cause, a downdraft in the trade, if you will, in the secular shift. That said, look where the stock is trading. It's trading where it was last spring. So it hasn't made a lot of progress. When you think about that lack of progress, it wouldn't take much as far as disappointing guidance to get this stock towards the lower end of that band. So how important do you think the NVIDIA results and guidance next week are?
I think even more important than they were if we are looking back a month ago, because as we've handed the baton back to large caps and had semiconductors still kind of move sideways there. I mean, the story all along has been that semiconductors were the darlings of the AI theme, and now we're looking at some other darlings and maybe a change in the competitive environment. So I think it does. The market hangs a lot of weight on what happens with NVIDIA. And as we know, it's much less about the actual results, much more about the forward-looking guidance. And expectations have been high for a number of quarters now. And when they come out and say anything that isn't nearly as strong or stronger than what the market is expecting, you end up with a disappointing move in the stock price. So this is going to happen, a week from today? We've got NVIDIA earnings next Wednesday. I would expect semiconductors to anticipate some of that news in the days leading up. So next Monday and Tuesday, I would be watching very closely how semiconductors are trading just as a group, as an indication of what the market is expecting. And then as they anticipate that news, that's what would need to be repriced if the news doesn't come in as we see.
Guy, really
Yes, Tim.
quickly, given what Liz just said, and given that rally that we've just seen, right? So the stock after the DeepSeek, a week later, it just barely had seen an uptick, right? And it was making new, I want to say 3 or 4 month lows. So that rally, that filling in the gap, in my opinion, makes it the expectations that much higher. We don't know where the stock's going to be next week when they report. But what's interesting is that the implied move in the options market, if you just look at the at-the-money straddle with next Friday's close, that would be February 28th, you're looking at like $13.50. Guy, you can do that math on 140. What percentage implied move is
Well,
that?
that's a little less than 10%. As a matter of fact, it would be 9.6% if I did that back of the envelope math.
You are amazing. And look, your hands didn't even move. It's not like you touched a calculator or any. There you go. You know what's interesting? I think it had a similar implied move last quarter, and you know what the stock did? It did nothing. It went sideways. So again, I think that's pretty interesting. And let's see how the stock reacts to guidance that I would be shocked is better than expected, Guy.
Yeah, well, it's interesting. It didn't do anything that day. The move was the ensuing day where stock made an all-time high and then closed on the lows. And we've talked about that. And I understand this rally in NVIDIA. There was an analyst about a week and a half or so ago. I don't remember which one it was. I'm sure our crack staff will help me here, but that upgraded the stock into earnings. And I understand that call because you're playing a little stock market. The stock had obviously sold off pretty significantly, and the bet was, they're going to people chase into an earnings release that, for the most parts have been pretty constructive for the stock. So we'll see. Real quick, this is to Elizabeth. I don't know the answer to this. I think I do, but I think it suggests the economy and the stock market are two different things. This is from Adam. Is equal weight S&P a good indicator of economic health? And, my quick answer would be, I think the stock market, the economy continue to sort of be on either ends of the spectrum. I'm curious as to your thoughts, though, Liz.
Well, generally speaking, you expect that the stock market knows things before the economy does, or at least the stock market knows before the data comes out. And if you look at the sector weightings, which is what I'm going to pull up so that I have the exact numbers for you. If you look at the sector weightings in something like the S&P, obviously we know that that's dominated by tech and communications. We've got 45% of the index in tech and communications alone. So if you believe that the American economy is completely represented by tech and communications, then that does represent the economy. But if we look at something like the equal weighted index, that's obviously going to have a much more spread out sector weighting, which I think is important to keep in mind. So when you think about the American economy, if we're talking about manufacturing, particularly in this administration, you want to see a heavier weight in things like industrials. You want to see a heavier weight in things like small caps, because small caps employ a majority of our workforce. So if we had to choose between a market cap weight and an equal weighted index on what represents the economy more, yes, absolutely. I think an equal weighted index represents the economy more, but still is not going to react at the same time as economic data and is going to have a lot more of a sentiment push to it.
Yeah, and I agree with that from the standpoint of, the lack of concentration with those top names. Top 10 make 30% of the, the market cap weighted SPX. And if you look at the RSP, where I think the next part of the generative AI trade is how different companies, how different sectors are getting the benefit from productivity gains. And guys made the example of Walmart with the acceleration of their e-commerce. So to me, I think the equal weight is probably a better way to play that if we do see that sort of play out in 2025. Talking about the administration, which Liz just mentioned, Guy, what do you make? We talk about this is like, I can't even keep it straight. Do we have tariffs on Mexico and Canada? What are they on? Okay, they're going to push those off, but some countries have already done reciprocal tariffs, and then we kind of do aluminum and we do, steel. It really is. And then we're going to wait until April 2nd, which seems like a world away. You know what I mean? Like, how do we deal with these sorts of headlines? Because this is the level of uncertainty, I think, that causes a lot of CEOs who are excited about deregulation, who are excited about lower taxes. It kind of leaves them sitting on their hands a little bit as they think about investing, CapEx, R&D.
Yeah, that's it. I mean, I think the market, quite frankly, has sort of figured it out. I mean, a VIX below 16 suggests the market is sort of desensitized to all these headlines. But I think the more important factor is, what does it mean for CapEx? And to your point, I think it's just sitting in the CEO or CFO seat. I think it's very hard to sort of game this out in terms of CapEx and spending and investments if you don't really know what the landscape looks like. And again, quite frankly, I mean, I think a lot of what you're hearing is thrown out there to confuse the situation and to sort of muddy the waters and to try to get a gauge onto, what's sticking and what the market is focused on and how are people reacting to it. So it's hard for me to have an understanding of how these things are going to fall when, and I don't say this in a political lens at all, when I don't think the administration necessarily has a full understanding on how these are going to sort of take effect or what the reciprocity is going to be on the other end.
Well, if they are negotiation tactics, as everybody has been talking about, part of the reason I think the administration maybe doesn't know what's going to happen is because you have to wait for the response. You have to see if the negotiation works. And so far it's worked-ish, right? I mean, we sort of put the screws to Mexico and Canada and got back apparently what we wanted on that front. Perhaps that works the same way going forward, but you can't really know. So I think, Dan, you're right to point out this puts CEOs in a position, CFOs and CEOs in a position to just kind of sit on their hands. There was another headline yesterday. We talked about this on Closing Bell yesterday afternoon, a headline about the M&A standards staying the same under the Trump administration as they were under the Biden administration, which for a lot of big businesses were deemed unfriendly because it was preventing a lot of that activity. I don't think that that's really a problem for the small and mid-cap businesses at this point, and that was actually where most of the expectation for M&A activity was coming from. But still, it's another head scratcher. It's another question mark of, oh, okay, so maybe the activity that we were expecting to benefit big banks, that we were expecting to benefit energy companies, the big ones at least, isn't going to come to fruition. But the answer is we don't really know, because just because the standards are staying doesn't mean that the execution and the interpretation of the standards is going to stay the same way.
Yeah, but Guy, it's interesting. The headline that Eamon Javers, I think you're kind of, putting these things together, was that some of the actions that were, initiated under the first Trump administration by the FTC and the DOJ as it relates to mega cap tech, they obviously got a lot of steam during the Biden administration, but the headline is that they are not likely to change course too much as it relates to, and that's fascinating to me because, again, think about Trump's relationship with a lot of those CEOs prior to what we just saw during the transition or in the lead up to the election. I think he would love to stick it to those guys. I really do. He got them to do the thing he wanted to do, come in, kiss the ring, donate to the inauguration, stand on the dais at the, at the inauguration, and then just continue to do what they always wanted to do, is basically, knock these guys down a couple pegs.
It's interesting you say that. I would agree with that. But I think he also understands, and I'll give him credit for this, that if he were to stick it to these companies and the weight of these companies in the broader market would be obviously, and I'll use the word, deleterious to the broader market. And this is somebody in the first administration that said the stock market is a report card for the administration. So as much as he probably longs to stick it to them, I also think he understands that by sticking it to them, he could potentially disrupt the market that he views as, again, a report card for his administration. So I think he walks with some trepidation there.
My only pushback is that all of those stocks did just fine over the last 4 years, while it seemed like every week
100%. But
let's take a little stroll around the world. Maybe Europe. We all like a little European trip every once in a while. Guy, you in for that?
And I'm going to do this European trip. And as Elizabeth mentioned yesterday, Tuesday, it was Tuesday, right? We did the Risk Reversal podcast, and we mentioned Mario, and he had called Liz over the weekend and pitched an idea about European defense stocks. So I wanted to preface that and then throw up what is these couple of charts that we have. Anyway, back to you.
Yeah, really quick, Liz. So we mentioned this. The first thing that Guy and I did this morning, we started looking at the Euro stocks. This is the bank index here. You look at that move, the consolidation that had been in since last spring. And I'm not exactly sure. Maybe it was a kind of rate cutting cycle that the Eurozone is kind of at least indicated to. And I know that they've been cutting rates at a time where maybe we started it out in September, but they've continued in that path where our central bank has got more hawkish. They've gotten more dovish. Look at that move. 30% in what looks like sort of a straight line. Let's look at the Euro Stoxx 50. Okay, so this is away from the banks. You have a similar sort of move here, not to 30% or so. Liz, when you look at this outperformance in the Eurozone, at least in the stock market, what are you getting a sense for? What do you think this is basically getting in front of?
I don't know that it's actually getting in front of anything. Well, it might be getting in front of a couple things, but I'll break it down both what it's looking at from behind and what I think it's getting in front of. So when we look at what happened into the end of last year and just the expectations for this administration to come in and slap tariffs on a bunch of stuff and just really not be friendly necessarily to Europe, I think that there was a lot of bad news that got priced in. If you just look at the price action of a large cap Europe ETF, a good one to look at is FEZ. If you look at the price action, it had a pretty bad end to the year. Some of the relief I think that's happening this year so far is that maybe tariffs haven't been quite as fast and furious as everybody expected. The other piece of this that's a little bit strange to think about, it's kind of a mind bender, and this is one that I worked through with Mario today, is the idea that if we pull back aid from Ukraine, then Europe sort of has to step up and probably spend more on defense. They probably have to spend more on government spending, which in effect stimulates the economy. If they're going to spend more with their governments, they have to issue debt in order to do so. There's a whole host of things that would have to follow in that pattern. Also, if there is a de-escalation between Russia and Ukraine, it could open up the energy markets from Russia back to Europe, which has been a little bit of a problem for many of the countries over there. So maybe some of that getting ahead of it. There's also a chart which I can show once we talk about my note about earnings, where you've got European earnings still not nearly as good as US earnings, but they're looking a little bit better. They're perking up a bit. And you want to have that fundamental support underneath it as well.
Well, you teed me up very nicely. Let's go right to your note, because you brought forth a few charts that suggest the outperformance vis-a-vis the S&P of not only Europe, but China as well.
Yeah, I mean, this first one is just to show everybody really what's going on, because I'm not sure everybody understands the magnitude. The S&P is up a little bit less than 5% year to date, which frankly is impressive. I mean, if we kept at that clip for the rest of the year, we'd have another over 20% year in the S&P, which would be great. So it sounds like it's impressive, but then compare it to large cap Europe, which is the blue line, and large cap China, which is the, I don't know, salmon colored coral line, something like that. Both up almost 15%. And then it's not on this chart, but if you look at the internet stocks in China, up almost 20% year to date. So the performance here just relatively has been pretty earth shattering. Now, I say that I know that there have been false starts before, but both of these regions, if we're thinking about just China and just Europe, have underperformed the US for the last 17 years. So it would be one heck of a turnaround if they started to outperform the US and actually were able to hold on to it. So what a lot of people are suggesting, and I would be one of these, is that if some of this fundamental support, and some of that support needs to come in the form of government spending in both regions, but if that stays put, then you've actually got a chance for a durable upside here. And this big spread, the natural question a lot of investors are asking then is, well, did I miss it? Am I too late? Or is this the beginning of something longer and more durable? I think it could be the beginning of something longer and more durable. And you didn't miss all of it. You probably are just getting in at the beginning of it, but you do have to be patient. This is a big spread. That's a big move in less than 2 months' time, likely to give a little bit back before it finds further upside.
Okay, sorry, Dan, go ahead.
Yeah, I was just to say, Guy, though, one of the things, and I get everything that Liz just said, technology is less than 20% of the Euro Stoxx 50, so it's a different trade, if you will, right? And so it is kind of, it has to be a cyclical trade. It has to be based on some of the things that, you just mentioned about basically, oil and natural gas flowing back into Europe and kind of, tamping down some inflationary pressures, right? If you think about where a lot of this inflation started, it started during COVID. It started with all the fiscal, but it was really accelerated, right, by the Russian invasion of Ukraine. Last thing I'll say is what you just mentioned about the hundreds of billions of dollars that have been spent, predominantly by us, or at least more than half of it. I think the number is like 350 billion or something like that. I thought it was a bit lower. Doug Cass just texted us something which suggests 350 billion. I know the number's out there. That's like a rounding error if you think about it on our budget and everything like that. Or, when you're going out and fighting war, we spent trillions of dollars in the Iraq and, whatever the war on terror was or whatever. And you could make the argument that this is just as important from a security standpoint. But the one thing I'll say is if there is a peace that is negotiated that Ukraine doesn't agree with, that the Europeans don't agree with, then the likelihood of continued uncertainty from a geopolitical standpoint is that much higher. And then you say to yourself, if you're a CEO or you're a prime minister, of a European country, you're on edge again. Then you have all that uncertainty. So I just feel like this is probably not the way, and I guess this sounds political or geopolitical, to kind of put the end to a war that was an aggressor, to one of our allies in a way that they have no seat at the table. I just feel like that is a recipe for disaster for the next few years.
That's been some of the consternation people have felt over the last few days has been solely on the back of that. And we'll see. But again, there is never, I think we all would agree, as much as we long for certainty. We've been few and far between in terms of that. But one thing you can't sort of quantify are the earnings and earnings growth associated with these countries. And Elizabeth brought these charts. So I guess my question to you, does the earnings support the outperformance? And I think these charts sort of sum it up.
So the first thing I want to point out about this chart is right there in the title. This is in US dollar terms. So this is adjusted for currency effects. And we know that the dollar has been strong. It's given a bit back in the last couple months, but a strong dollar has affected the way that the earnings are going to read for China and for Europe. So keeping that in mind. But the other thing that we wanted to answer in this week's blog is that you can't just look at performance and say, okay, that means that I should buy these stocks, right? Because suddenly they've done well. You have to have some other support behind it. So then let's look at, is there other support behind it? So you can obviously see the S&P earnings line on this chart in the dark purple. There's been a step down. We've had a lot of revisions to 2025 earnings that have been downward. Now, everything's still expected to be quite positive, above 12% growth all in, but there has been a slowdown in the expectations. China obviously dealing with some weak currency over there, which is what you're seeing in this sort of dredge downward. And my thesis on China, as I've laid out many times, is really more about government spending and stimulus. I think they will get themselves out of those doldrums with the government spending and stimulus. And then this European line, also very interesting because it's showing this sort of slow grind higher. Now, still behind the US, only showing about 8% earnings growth for the next 12 months, which pales in comparison to our 12.7 or whatever the number is. But if they can find their way above and continue moving upward, it does support that. And then couple it with the fact that valuations are just that much more attractive. You don't have to pay as much to get each incremental dollar of earnings. And I think that's where both of these regions have gotten much more attractive to investors.
So, Guy, that spread, I love that chart because you see that step down in the purple. That's the S&P 500, and that came right around earnings season. And we had been remarking all Q4 about how expectations were stuck at that 14% year-over-year earnings growth. And here we are, we have a little bit of a step down. I think the lower that line goes is better for the S&P 500. And why do I mean that? Because the expectations are coming lower. The expectation of upside to that number, I don't think was there. If you look at all the S&P strategists or the targets that most of the strategists had, they were looking for maybe high single digits growth off of like a 5,900 number in the S&P that we had in Q4 or something like that. So here we are back at 6,130 or whatever you said at an all-time high. I think the best thing for the market could be analysts getting too pessimistic about that double-digit earnings growth, which you could just see the trajectory of that purple line. They really hadn't come down one bit until about a month ago, Guy.
Yeah, and I understand what you're saying, but the math is the math at a certain point. Doug is texting us while we're doing this, and if you just look at again, and he's the first to say it, and the three of us are also say it. These metrics that we bring up are not timing indicators, but through a myriad of different lenses, the market is expensive. And what it means is, in my opinion, it gets less and less room for error. And, if earnings growth were to, again, come in meaningfully, analysts can get as negative as they want. That's going to have an impact, I think, on the broader market at these valuations. So, we'll see. Listen, again, we'll see how it all plays out. Nobody wants to hear this, as with each passing day, we make a new all-time high in the S&P. But, the numbers don't lie. They are what they are, Dan. And, if history is any guide, it's just a matter of time before things sort of correct themselves.
So Liz, if somebody were to go to the SoFi blog, what
Wait,
sort
I
of
have another chart?
well, I know we're not there yet.
Oh,
I'm just
okay.
saying, what would they look for? What would they search for? What would the name of this report that you just wrote up? What would it be? Because I think it might aggravate Guy Adami. I don't know. Let's see.
Oh, you mean the title
Yeah,
of
the
this
title
one in
of it.
particular?
Yeah.
The title of this
Yeah.
one is Study Abroad.
Oh,
Study abroad.
yeah. See what you did?
That had a different meaning for me in college, by the way.
It did, yes.
Those were,
I thought it was
instead of 2 words, they were 3 words for me, if you want to.
Get it?
Oh,
Abroad.
dear.
Yeah.
Moving on.
What a stud
Next
he was. You ever see
chart.
some of the pictures of him in college?
I have seen a picture. I've seen one.
There's one picture. Was it the one where he's wearing the Airplane 2 hat?
No, he
It's
has like a striped
amazing.
button-down shirt on. Maybe that wasn't college.
It's amazing.
He had like a button-down shirt on. That
You didn't even know that there was a
an
second
array.
Airplane. There was a sequel to that.
No,
Yeah.
no.
All right. So I'm sorry. I didn't mean to
Anyway.
cut you off. I just wanted to
Oh,
get
I
your
thought you were
title
trying-
out there. No.
I thought you were trying to do the blog thing already.
No.
Okay, the last chart, this kind of goes to what we were just talking about and whatever Doug is texting you, I'm going to assume. So this looks like a really boring chart because all 3 of these lines are just moving sideways, but all it's showing you is that the S&P 500 consistently trades at a more expensive multiple than both Europe and China. Now that probably stays that way. Maybe there are short periods of time where the lines cross over, but for the last year, it's been consistently above, and even there's been periods where it's grown, that gap has grown. So to the point of, first of all, US stocks are more expensive than these other 2 regions, and we're at a point in yields, and we're at a point in our inflation cycle where we have to pay closer attention to what those valuations are and what we're paying upfront for stocks. But the other thing is, when you look at just valuations in general, and I'll say this is the sentence written right underneath this chart, valuations are not a good timing mechanism, but they tend to be a solid tool in setting expectations for future returns. Now that's over longer term periods, but basically you can look at valuations, compare them to history, and tell yourself, okay, I need to manage my expectations for what the next 5 to 10 years of returns are annually for whatever this group of stocks is. And I think that that's something, particularly when we compare the US to Europe and China, that investors are figuring out.
Guy, can we do the equity risk premium? Because Doug sent us this one.
And listen, I mean, he's spot on. I mean, and again, the things that he sends us, I'm happy that he does it, because these are all really important. These are all really important metrics. But again, Dan, nobody seems to want to heed the warnings that they're saying. So yeah, you want to talk about the equity? I'll read it.
Yeah.
This is how crazy overvalued the S&P 500 is. And if Amanda can throw it up, the current 22 times forward multiple only makes rational sense in an environment where the 10-year tip yield is close to 0.2%, not 2%. So this is 10x basically where we are right now. We ran some regressions on the multiple against a real risk-free rate, and the equation spits out a fair value of 15.4 forward PE multiple. We then went deep into history books and found that when real rates were today's levels, the multiple averaged out to be about 16.6. I'll round it up to 17. That's still a few turns lower than where we're currently trading, Dan.
Yeah, you know what I love about this sort of data and this sort of, analysis of the data is that, you can kind of smooth out all the excitement about generative AI, because this data includes the excitement about every other major sort of hype cycle that we've had, right? And so you could make the argument, well, it's different this time than it was during the .com or this and whatever. This kind of strips out all of that. And what are some of the main inputs to valuations of the stock market? It's obviously growth expectations. It's obviously yields. There's, a couple other things that really don't, Liz, account for, some of the hype that's existing in the market right now, which is pushing up the multiple at this moment. You look at equity risk premium. How important is this to you? It's a little different take on valuation.
It is, but it's been telling us that things are overvalued for a long time and nothing's happened, right? I think actually what we're dealing with in this market is that there's so much more liquidity than there has been in prior markets. And that's what's been still feeding everything and keeping it propped up. So it'll be an interesting year to find out whether or not the US actually does outperform again if this US exceptionalism theme continues. I think at some point valuations have to come back down to earth. It's just now more a matter of how does that happen? Does it happen in an orderly fashion? Does it happen because earnings actually go up and the price stays about the same? Does it happen in some sort of very violent and dramatic fashion, which I don't think any of us hope for? But at some point, things have to change, and some of the lines on that last chart that I showed probably have to come a little closer together.
Amanda does amazing work. And I love this one is great. Call of the day. This is from Cantro. That's Michael Kantrowitz of Piper Sandler. And he's saying, forget about Dan's, what do you call it?
The Fateful Eight.
He calls it the Magnificent. I don't use either term, by the way. I don't think it's ever crossed my lips, but there you go. He says, forget about those. Here are some more interesting names that can outperform. And, these are 4 pretty cool names. Here's the problem with, there's not a problem. CrowdStrike, the time to do this was last year when they basically had that issue. And we actually talked to Stephanie Link about this. Now, CrowdStrike has regained all what it's lost. And I think as we're sitting here, is making an all-time high. The one that sticks out to me here, Dan, if you want to play a little stock market, is Qualcomm, because that's one that's been sideways to lower now for quite a period of time.
Yeah, and again, I think Qualcomm and AMAT, while they're 2 very different names, obviously AMAT is a chip maker, or chip maker supplier. They make the machines that companies that run fabs make the chips. This one, I've tried to take a stab at here and there from a valuation standpoint, from the whole idea of reshoring a lot of this fabs here to the U.S., reshoring away from, let's say, Taiwan and China. You think this would be a big beneficiary. It's kind of stuck in the mud. It had that rally last spring, but again, cheap stock. Qualcomm, a little different one here. Let's pull this one up. This is a company that's not particularly well exposed to the secular shift of generative AI. Are they a supplier to Apple? Yeah, but a lot of that business is likely to go away over the next 5 years or so. They're also a supplier to Samsung. Handset business sucks right now. It just is. At some point, there are going to be some smartphones that are probably on the leading edge of generative AI for consumers, but they're just not there yet. One of the stories for this last year was that all of these Copilot PCs that are coming from Microsoft that's integrating, OpenAI technology was going to be a boon for them. It just hasn't played out. You saw that guidance guy that they gave, I want to say a month ago or so. So when you're looking at some of these names, you might be looking at value traps. I don't think that's the case for CrowdStrike, because I think a lot of folks think that the next leg of this trade is going to be in security. That's the generative AI trade in security. But I don't know. Do I like these? Does this look like a bearish to bullish reversal, as our friend Carter might say? Yeah, possibly. But just understand, you're buying a stock for a reason why it's trading at 15 times earnings. There are reasons that it's not participating in the shift. So
yeah, again, and real quick, I'll say this. It sounds somewhat counterintuitive, but the trader in me suggests I'd rather buy Qualcomm on a breakout above 180 than to buy it here and then be like, well, that's dumb. Well, it probably is. Most of the things that I say are dumb. However, the trader in me suggests you're buying the breakout rather than buy it here, because I think a close above 180, I think your chances of, again, getting this subsequent move potentially to the low, 210s, 215s are much greater. With that said, Amanda also used her skills to do the following, and I am troubled by this in ways that proper words do not describe. Like, what did you guys do? What is that? That's
I don't think I saw who was doing this.
You know what's going on here? So I think this was Jacob. So you remember the shades, Liz? This is during the meme stock thing. That meant you were just like pretty cool. Rocket ship meant that the stock was going to the moon. And diamonds meant diamond hands, I think, a little bit. So that means you would hold on and not be afraid. But Liz, we kind of thought we were beyond meme stocks, right? So look at this Hims and Hers. This is a telehealth company that went public via SPAC, I think, in late 2020. And if you go to a 5-year really quickly, you'll see that it was a little memey back then, okay? But then this thing was trading at like zero for all intents and purposes at one point in 2022. And some of the themes in and around telehealth had to do with this GLP-1. These guys sell the compounded version, but they also have a whole host of other things. I mean, I don't even think they're like number one in the space, but there's scarcity because it's one of the few names in the public markets. When you see this sort of behavior and you use that term late stage, early stage, this and whatever, let's all agree that this is probably later stage for some of the trends that we've seen over the last couple of years. Is that bullish or bearish to you? It's a $15 billion market cap, and it's gained probably half of that in just the last few weeks.
I mean, this is not a comment about the company,
No, of
but
course.
first of all, I've talked about slopes before. I mean, the slope of that line is darn near 1 all the way on the right-hand side of the screen, which is usually a scary chart to look at. I'm also looking at the short interest. We've got short interest in this name of about 34%.
It's crazy.
That is high.
Yeah.
That is very, very high. So what does that mean? Does that mean that the shorts are wrong and the longs are right? No, it doesn't mean either or. It doesn't mean that the longs are wrong and the shorts are right, but it does mean that there is opportunity for really big swings in this stock, even on the tiniest little moves. So I would be careful. And that's certainly not a chart that looks like a good entry point.
Guy, when you see short interest at that high, okay, for a stock, this clearly is fueling a lot of this rally, right? So shorts are tripping over each other, to buy back their stock. There's been a lot of options activity, which gets a lot of dealers involved. A lot of folks, can't see what that action really means, but this has really gone from, look at this thing, I think from, $25 up here to, what is it trading at, $70?
72, yeah.
I mean, that's insane, but you'd be crazy to short it. Right. And the idea of buying it here seems ludicrous unless you're one of these really nimble intraday traders.
Yeah, well, the short trade is very difficult for most lay people. I get it. And if you wanted to do it vis-a-vis options, my instincts suggest volatility is blown out to a level where you'd have to catch it cold to be right. And that's obviously not easy to do. So standing on the sidelines is probably best. If you have enjoyed the move higher, it's incumbent upon you to do something. You absolutely have to move your feet, whether that's to, sell an upside call, understanding that does not provide you with protection, but you probably paid a good deal to do it, or take a quarter, third, half of your position off. You have to do something. Now, by the way, I would have said that $15 or $20 ago, and that would have been theoretically wrong, but at least, again, it gives you some optionality. But when I see this, and you asked about short interest, listen, we have entered an environment where people have gamed out and are shooting against stocks with big short interest. And that's proven to be a very effective technique. It's not to suggest that the work that shorts have done are not right and they're not going to be right. But we found ourselves in a period of time where when the market identifies a big short interest stock, they're going to shoot against that. And I think you're seeing it right here. It's playing out right before our eyes.
Yeah, just to give some context about the expected movement in the options market. So here we are. It's February 20th or so. February 19th? What day 19th. Are we? 19th. The March 21st expiration. So that's March regular way straddle. Okay. The 70 strike straddle. That's the call premium plus the put premium. You put that together. That is the implied movement between now and March expiration. That's about $23. So the options market is suggesting that this stock could go $23 in either direction in the next month or so. So it's just telling you how difficult it is to play a name like this, long or short. And then on the short side, the stock has this crazy borrow. So you need to get a crazy move lower to actually earn that out. So again, we just bring this up. We're not suggesting to buy it or sell it. I started the question to Liz. When you see this sort of price action in names like this, does it make you feel more bullish about a market that's up or less bullish? And again,
I'm wondering something, and I think about this stuff in my own portfolio. This would obviously be a short-term gain for people that if you got into it recently, you rode it all the way up, you got a short-term gain, and you're looking at it saying, I don't like to take short-term gains because that's taxable and I'm going to lose sometimes half of my gain, right, to taxes. So how often do you think people make a decision based on taxes and end up screwing themselves?
I think a lot of short-term, and Guy, I'd love to get your take. I think a lot of short-term traders, I know myself, if you catch a move like this, I mean, taxes, I'm going to have losses too. You know what I mean? So like sometimes I think about that. But yesterday on the market call, Walmart reports tomorrow before the opening, and we detailed our bullish case. We looked at the technicals. We looked at what the options market was suggesting to us. We said, if you're long this stock and you believe in the story and you're not particularly worried about if the stock were to come in 5%, which is the implied move, then fine. You just stick with it. You know what I mean? Like it doesn't matter. But let's just say you bought it on that gap before earnings, back there in August, and you've seen the stock go from $70 to $103, and you're like, I want to continue to actually have potential upside, but I kind of want to cap my losses to the downside. We detailed a collar trade where, to Guy's point about before, you got to move your feet and do something, selling an out of the money call and using the proceeds to buy an out of the money put. What you do there against long stock is you're giving yourself the ability to appreciate up into that short call. You have losses down to that long put, but you've collared that position. You're basically doing this if you believe there's more potential downside near term than there is upside. So I like that strategy, but again, in a name like Hims and Hers, I suspect that there's a lot more skew to the calls. So, you know, that could even make it that much more attractive, because in these outright manias, people want upside calls more than they want downside puts. And I think that's one of the things like should be, or at least should get your antennas up a little bit.
I'll say this, you know, the game, and I'm using that word, the market game that we play seemingly on a daily basis is hard enough. When you introduce another variable in the form of taxes, it makes it that much more difficult, and it creates a one more reason to be paralyzed by the thought process. But it also harkens back, and we'll end on this note, to a scene in the great movie 48 Hours, when Eddie Murphy is in the bar and he's patting down one of the rednecks and he pulls out a wad of cash, and Eddie asks him, "Where'd you get this money?" And the guy says, "Tax refund." And Eddie says, "Bullshit. You're too stupid to have a job," which is one of my, I still use that line to this day, Dan.
It's amazing. Really quickly, I just want to demonstrate exactly what we just talked about, the skew to the call. So again, I'm looking at March expiration. The stock is at $71. Let's look at $15 out of the money. Okay, let's talk about the 85 strike call. It's trading at $7. Okay. Now if I go down $15,
$4.20,
$3.30. So think about
that.
The calls, $15 out of the money, are basically, and it's $1 away, 71. But basically, it's twice as much as the downside puts. That's telling you that folks are just offsides on this thing altogether. You know what I mean?
Risk on the upside.
And part of it is, if you're short, you might look to buy calls to kind of, you know what I mean, hedge yourself out, if you will. But that sort of behavior, crazy.
I like that. I thought I'd be close to 420.
You're too stupid to have a job. So
bullshit. You're too stupid to have a job. Eddie Murphy.
Nick Nolte.
By the way,
you love Nick Nolte.
I love Nick Nolte too. Nick Nolte he went off the crazy train. Eddie Murphy is a genius.
No,
Eddie Murphy is a genius.
Gary Busey went off the crazy train. Do you know either of these actors? Yeah, Gary Busey. Do you remember in Point Break? Utah. Sure. Give me two.
You wanted the meatball sandwiches.
Movies with me.
Utah. Give me two. Liz, is that enough?
Remake that, by the way.
You done with us?
I love you guys.
And if you can, who was the love interest of Johnny Utah in Point Break? What was her name in real life?
She was in Tank Girl. I remember. She
was also in A League of Their Own.
Yeah.
You want me to give you her initials?
Yeah, I'll get it.
LP.
Lauren. What is it?
Lori Petty.
Laura Petty. I kind of knew it. It's not she's not a great actress. Let's be very clear on that one. I mean,
I wouldn't say
that. You know who was in that movie?
Do
you remember when Johnny Utah is trying to like get his surf cred going on? He goes, "You've never seen Point Break?
No.
It's one of the best movies of the 80s, guy." And you know who was in it? The guy from Wall Street. You remember the Irish guy?
Gordon Gecko?
No, he's amazing.
No, the guy that said, I got 2 tickets. I'm offering you the Knicks and Chicks. He worked on the trading desk.
Yeah, but you know, Anthony Kiedis and Flea from Red Hot Chili Peppers were in that movie. They were the two guys that are beating up Johnny Utah. This is Keanu Reeves. You don't have a thing for Keanu Reeves?
No.
Oh my goodness.
I mean, I don't not have.
He's on my wife's list, by the way.
Keanu Reeves neutral.
Yeah.
I love Keanu Reeves.
He's the best. Those 4 John Wick movies, I'd put them up against any action series that has existed in the last.
Swayze, genius. Lost him too soon.
He was great. I really loved him in Ghost.
Okay. I wasn't going to go there. I was going to give you a little Outsiders, but okay, Ghost. I mean,
he was
that's
great in the Outsiders. Yeah. Okay, should we move on, Liz? Are we done?
Well, we're done.
Yeah.
Where can we get Liz's note? Throw that up the tic-tac-toe board with
All
all
right,
the
it's
hyphens.
SoFi.com/on-the-money. Or Liz, where can they go to get
You know what you can
study
do?
abroad?
You could just go to the Google machine and type in Liz Looks At. That's
Yeah.
the name of the blog. When
Wait,
I'm
guy,
out,
did you know that? It's the title is Liz Looks At?
Liz
I thought it
Looks
was
At.
the important part.
That's
the
the
podcast.
Oh.
When I'm out, Mario will be writing the column, and it'll be called Decoding Markets.
Okay.
You know what? We're gonna give Mario a little bit of the Butters treatment while she's gone, guy. We're gonna get the note Liz Looks At, and we're just gonna kind of, we're
Decoding
gonna
Markets.
yeah.
Because Liz will be looking at a baby.
We'll call it, watch this. Instead of Mario Kart, we'll call it Mario Chart.
I'll run that one by
Will you
him.
guys do this? Will you put in the chat what you think some kind of preferred names for Liz's baby might be? Because that's how we could arrive at a name. Don't you think so, guy? I mean, she's stuck with possibly,
what do they call that? Like,
we are
like
definitely
when you
looking
put it
for-
out there to the world, like, you just throw it out there and
we could do a survey.
crowdsourcing or something.
Yeah, Amanda Diaz could put next Wednesday. Amanda will put a survey with like what the name should be, and we'll tabulate it, and then maybe you just take the winner of that survey. And
Okay.
go with it.
Yeah, that's
Because
like
Guy Christopher and
Dan.
Daniel Steven, either one of them will roll off the tongue. I'm sure your husband would love that.
Yeah.
All right. See you later, everybody. We'll see you back 1 p.m. Eastern tomorrow. Guy Adami, we're going to have a risk reversal pod dropping tomorrow also. We had a great one today. You and I, we went a little different place than we normally do.
Geeked out into the private markets.
Yeah,
I mean,
we
I
did.
thought it was good.
But it was a lot of defense tech and a lot of stuff that's going on in and around AI. We had a lot of fun with that. All right, peeps. We'll see you. Thanks.